Japanese candlesticks charts. Why traders use Japanese candlesticks charts is because it gives more information about the market. But before we look into it, let's look deep down to the origin of Japanese candlesticks charts. Who was the founder of Japanese candlesticks charts? Monehisa Homa. Let me write his name for people who don't know. Monehisa Homa was the founder of Japanese candlesticks charts way back 17th century. So these Japanese people have been using candlesticks charts to trade rice since the 17th century, but the Western world didn't get to find out till the late 19th century due to the widespread of personal computers and also banks and also transactions.
Why was rice so important to him? What was so special about rice during that time?
Well, because a lot of people were trading and dealing with rice way back 17th century in Japan. It was like something that was traded more than the gold and silver as of then. And also he had to find out a way to understand the market by tracking the actions of the buyers and the sellers, and also the emotions of the buyers and the sellers, which gave birth to the candlesticks charts, which we understand today. Because with the candlesticks charts now, we tend to understand the opening, the high, the low, and the closing of the market, which the bar chart or the line chart doesn't give that.
So when and why did the Western world adopt the candlestick charts?
The Western world got to find out about the candlesticks charts after 2 centuries. In short, almost 3 centuries, because it was the late 1980s rather. So due to the wide use spread of computers, personal computers in particular, and also the transactions of buying and selling, money markets, and also it made it easier for traders. They realized that it made it easier to read, analyze, and understand charts better than the line charts and also the bar charts. That's the candlesticks charts brought about the understanding of the high, the low, the open, and close of a market, which made it much more important, because at this point you understand where the big players are. These big players are the banks, the hedge funds, and you can actually make a proper decision making from it. Also, human behavior is widely influenced by fear, greed, and hope. So the candlesticks analysis helps us understand how the buyers and the sellers interact with each other in the market. So understanding the candlestick will help you understand what the big players are doing in the market, and it will help you also understand when to buy, when to sell, and when to stay off the market.